A very good evening, ladies and gentlemen. We are back with yet another another exciting session on how to add value in decision making of corporates by data analysis. The chief guest of the day is none other than my very dear friend CA Manmeet Singh.
I think there is some audio problem.
Saurabh sir, you may proceed further.
Okay, so I guess Nanda sir is traveling and he's facing some network issues. So let me begin. So a very good evening, ladies and gentlemen. I, CA Saurabh Arora, extend a very warm welcome to you all in today's virtual CPE meeting on the topic Management Accounting Insights, Data Analysis for Corporate Decision Making. This webinar is being organized by Committee on Management Accounting under the able leadership of CA Charanjot Singh Nandaji and is being hosted by Faridabad branch of NIRC of ICAI. Today we have with us the very well-known speaker and faculty on DISA, CA Manmeet Singh Mehta ji, and we also have the eminent speaker for today, CA Dr. Sangeeta Pandit ji. We welcome you both on board, ma'am and sir. As the topic for today is Management Accounting Insights, Data Analysis for Corporate Decision Making, I think that we all must have heard that there's a saying that goes like, data is the new oil. And if that is so, then interpretation or analysis is a filtration process that provides a key ingredient, that is information that is actually required for decision making. So without further ado, I think we also have with us CA Harsh Kumar Mittal ji, Vice Chairman Faridabad branch of NIRC of ICAI. We welcome you, sir. So now I request you to please take over for the welcome address, and I think Nanda sir has joined us again, and please give your welcome address, and over to you, sir.
Thank you Saurabh ji. Good evening to all and one present in today's virtual CP meeting. It's my pleasure to present welcome address in absence of our Faridabad branch chairman, CA Jitendra Chawla ji. Very respected and honorable chairman, CA Charanjot Singh Nanda ji, Committee on Management Accounting. Eminent speaker, CA Dr. Sangeeta Pandit ji, who will give us insight on management accounting and data analysis for corporate decision making. CA Nankishore C. Hegde, Vice Chairman Committee on Management Accounting, our chief guest and eminent faculty on DISA, CA Manmeet Singh Mehta ji, session moderator, CA Saurabh Arora ji, all other distinguished guests present in today's VCM on our ICAI channel. Ladies and gentlemen, ICA Harsh Kumar Mittal, Vice Chairman of Faridabad branch of NIRC of ICAI, welcome you all in today's VCM. I have also given the responsibility to introduce our CC member, our motivational guru and chairman of Committee on Management Accounting, a good orator, I must say, C. Charanjot Singh Nanda ji. If I will read out his profile, I think half of the time of today's VCM will be over. So I will just give the brief profile of his. CA Charanjot Singh Nandaji is in profession as a practicing chartered accountant since 1991. And he has interest in the field of capital market, banking, human relation, management, corporate law, taxation, audit, management, and consultancy. He is currently a Central Council member from the term 2019-22. He was also a member of Central Council of the Institute of Chartered Accountant from 2004 to 2016. He was also member of Northern India Regional Council of the Institute of Chartered Accountant for 2 terms, 1998 to 2001 and 2001 to 2004. He was also chair the Northern India Council of Institute of Chartered Accountant from the term 2002-2003. He has very much he has hobby in public speaking. All of us grown by hearing his stories, motivational stories. Apart from these NIRC members and ICAI, he was the Joint Secretary of Student Union of MLN College during 1986-87. Was an active member of debating team of Dean Nobili School and MLM College. He has authored a professional book, A Practical Guide on Audit Documentation for Statutory Bank Audit. Currently, as of that we are having this virtual CPE under his chairmanship, Nandaji, I also welcome you all. Welcome you in today's virtual meeting. Now I hand it over to CA Saurabh Aroraji to further proceed the meeting.
Thank you, sir. Thank you so much. Moving further, I would like to ask CA Nanda Saab that, sir, would you like to say something? Earlier, your connection was interrupted.
No, I'm fine now. I'll make the keynote address.
Okay,
But
sir.
before those, I want to tell you, ladies and gentlemen, it is my proud privilege to welcome the chief guest of the day, CA Manmeet Singh Mehta, an eminent speaker and faculty on information system audit. I'm honored to welcome Madam Sangeeta Pandit, who is the speaker for the day, my younger brother, CA Harsh Kumar, who is the vice chairman of Faridabad branch, and again my younger brother, the youngest brother, CA Saurabh Arora from Jammu. And all participants have come here to go home more enlightened. Ladies and gentlemen, I am truly honored and passionate to come and present the keynote address for the day. But before I proceed with the keynote address, I want to tell you 2 very important things that transpired on CA Day, which is 1st July 2021, when we finished 72 glorious years in this profession and stepped into 73rd year. First important thing, we have now decided in the council that if unfortunately any CA student loses any of his parent, he would not have to pay the fees, the course fees would be pardoned. And secondly, we got a gift from the Ministry of Corporate Affairs. They allowed setting up of multidisciplinary partnership funds, meaning thereby that you could, in a CA firm, have an advocate as a partner, as a company secretary, an ICAI, architect, advocate, MBA as a partner. But that person who comes to you as a partner needs to be regulated by any institute which is able to take care of the disciplinary proceedings. So, ladies and gentlemen, give me a second before I put on my PPT. Just a second. My PPT. Just a second. Is my PPT visible, sir? Should I start?
Yes, sir. It is visible
Great.
to all.
So today we are discussing on a very important facet which speaks of data analysis for corporate decision making. So when we start, what is data-driven decision making? Let me tell you, the wealth in today's time, easy. The wealth in today's time is data-driven decision making. The reason, the wealth in today's time is only data. And that data which you possess have to be maneuvered, have to be synchronized so as it is able to give you the best of the results. So data-driven decision making is a process that involves collecting data based on measurable goals or key performance indicators, which gives you strategies and activities that can benefit the business in a number of times. Very, very important. So one needs to understand that data-driven making means working towards key business goals, the mission, the vision of the board or the audit committee by analyzing data rather than moving in the dark. That is very, very important. The third thing, now what is data-driven decision making? First, you extract the right data which you index, the right inference data which you are working with needs to be accurate as well as relevant to aims. In today's competitive times, the boards are totally driven by the analysis of the data which they receive. Collecting, extracting, formatting, and analyzing insights for enhanced data-driven decision making. The decision based on the results or inferences drawn from the data. Second, you are aware that today the development and democratization of business intelligence empowers users to analyze data and to extract insights from that data. This involves shifting large amounts of raw data. You have so much data, so you need to understand which data needs to remain and which needs to be eradicated or trashed. The gold that data scientists mine comes in two distinctive types. One is the qualitative data and other is the quantitative data. Now, what is qualitative data? Qualitative data focus not on numbers, but on facets like interviews, like videos, and anecdotes. Quantitative data focuses on numbers and statistics. The median, standard deviation, and other descriptive statistics play a pivotal role here. And in this type of analysis, something is not observed, it is measured and brought into book. What are the benefits of data-driven decision making? First, make more confident decisions. Yes, backed up with data-driven movements, you can assure that certain things which have a relevant prescriptive value are in preposition. You become more proactive. Yes, because you know that this has been the past and this has been the trend. Moving with the trend makes a person very, very successful. Third, achieve greater success and longevity. Longevity and success is gained once you use the data for your benefit. You gain awareness and transparency because now you are on the storehouse of research data that would add value to your proposition. Answer the why. You are able to answer the questions. You can't just shoot the arrows in dark. Identify new revenues of growth. Once you get into proper data discussions, you are able to get newer ideas where you can work. Now, how to accomplish a data-driven culture? There are 6 building blocks. First, leadership. Yes. Leadership is the most important thing which one uses in case of achieving success. And data gives you the proper weapons which you can use. Trust. Trust is again another very, very important data-driven fact. If you have trust in the data, you feel it is accurate and trustworthy, you are able to work essentially on that. You see, there are certain political parties who gain mileage on data. There are certain companies, there are stock markets who live on data. So if the data is trustworthy, the outcome is always trustworthy. Commitment. Building a data-driven culture cannot be set in and forget. It is the value of commitment. It has always to be brought into the right perspective and then only you move ahead. Next, the fourth is metrics. Yes, the right key performance indicators drive the data. You need to understand what you want to derive out of the data. The data can give you thousands of inferences, but what you need to know, data literacy, understanding how to interpret data. When I speak about technical charts in stock market, you'll be astonished to know that different people with the same chart draw different analogies, different workings. So we need to understand that data literacy is very important. And last is training. Yes, if you are trained well, you work well, you exhibit well. Now, what are the tips and takeaways for an enhanced data-driven decision making? First, guard against biases. Let your mind be very strong. I want to tell you, ladies and gentlemen, one very important thing. It is the mind of a man that makes him or destroys him. If you want to perish, go on a different mindset, be weak. And if you want to be strong, for God's sake, develop a mindset that helps you to perform. I am reminded of a couplet which says, कुछ इस कदर बदहवास हुए आंधियों से कुछ इस कदर बदहवास हुए आंधियों से हम कि उन पेड़ों से लिपट गए जो खुद ही खोखले थे. Once you work, the most important thing to understand is how you need to exhibit your thought process, how you need to toe the line. Second, define objectives. The objectives have to be clearly known to you. The mission and visions of the business have to be very handy. Gather data, look at data. Complete data is a boon. A fragmented data will give wrong results, which can ultimately be a big reason of your perishing of your business. Analyze and understand the data, which is the most important thing, analyzing and drawing the right inference. Find unresolved questions and ways and means how they can be resolved. Find the data needed to solve these questions and resolve all the conflicts. Seventh, revisit and re-evaluate. Have a proper call on the data system. Eighth, present the data. Show the data. Ninth, set measurable goals. The goals on which that data can be used. And 10th is continue to evolve, continue to do things which are helpful to you. So ladies and gentlemen, I go on to the last slides of my presentation. I have discussed this all. So at the last, I would like to tell you that if you are able to take proper decisions from your data, you are able to work in tandem with the thought process of a right perspective. The basic purpose of bringing data and analyzing is to empower the management, to empower the people who are totally involved in creating the strategies to have a robust, to have an effective means to assimilate the knowledge and more importantly, resonate it to the board or to the audit committee as the case may be. I am very confident with two learned speakers we have today, Mr. Mehta and Madam Sangeeta Pandit. You will have a very scintillating, very mind-boggling and enjoying session. So over to Saurabh Arora ji for further proceeding. Saurabh, the dice is all yours now.
Thank you, sir. Thank you so much for the address, sir. We are very thankful to you that even if you are traveling and your commitment is, I will say that your commitment is second to none, sir. Thank you for the address, and within that short span of time, you have just summarized everything from top to bottom. Everything you have just put it across in a very, you can say, filtered way. So thank you, sir. Thank you for the address. So moving further, we have CA Manmeet Singh Mehta ji. So before I give away the dice to Mehta sir, I would just like to read out his professional qualifications and about his work experience. CA Manmeet Singh Mehta ji is a CA, FCA, CISA, CDPSE, CFE and DISA qualified chartered accountant. He has also done BSc and is also an LLB. As far as his work experience is concerned, he is a faculty with the Institute of Chartered Accountants of India for the Information System Audit course DISA and has to date conducted over 6,500 hours of programs for chartered accountants and audit professionals all over India. He is also a faculty for Information System Audit courses conducted by the Institute of Chartered Accountants of Nepal. He is a faculty with the ICAI providing training in MS Excel and CAT areas. He is also faculty trainer at training programs on financial and banking detection fraud. He is also a speaker at seminar on forensic, system audit and data analytics at ICAI Dubai chapter NPIO. He is also a faculty trainer at faculty development program on forensic audit conducted for faculties of Delhi University and Amity University. He has also conducted training for senior inspection of staff of Oriental Bank of Commerce and at the Staff Training College. He is also a resource person for GMCS and orientation programs conducted by branches of ICAI and COE Jaipur. He is regularly conducting various virtual training and on forensic accounting, data analytics using Excel as a productivity tool, dashboards. These are some of his work experience regarding information. So I would just like that, sir, we are privileged to have you on board with us today. So the dice is all yours, sir. Please, Mehta, sir.
Thank you, Saurabh, and a very good evening to all of you. I'm really thankful to Committee of Management Accounting and the Faridabad branch, especially Nandaji, for giving me this opportunity to interact with you on the subject which is very close to my heart, which is data analysis. And it's really good that the committee is having this kind of a program, which is the data-driven decision making. And friends, the fact is that the way forward is data-driven decision making. In 2008, there was that, America was in dumps because of that subprime crisis. And in that crisis, Starbucks, hundreds of stores of Starbucks were closed. And that was the time when Howard Schultz, who was the CEO of Starbucks, decided that all our decisions would now be supported by some kind of data analysis. So they took a stand that we'll have now a data-based analytic, data analytic-based, decision approach. After that, what happened was that Starbucks decided that any store they open, they'll first have the data about the store, where it is located, what are the demographics, okay, what is the they even look at traffic, what is the flow of traffic at that location, okay. Then they'll also take inputs or the data from the regional staff just to see, and they've got data analyzed to such an extent that they can predict before opening a store that what would be the revenue for this store, what would be the footfall in the store. So all their decisions they have decided would be based on some kind of data which is there. So that is the extent of decision making which organizations are going in for. And Google, which is very famous, I'll say, for their data-driven approach, because for everything they have the data. So some years back, they started they started the project Oxygen. Here they collected around more than 10,000 profile of their employees. So as you know, I mean, Nanda have said that we need to have analytics for everything, right? So they took around 10,000 profiles, and they matched it with what were the performances. Now, based on that, they have their data analyzed to such a state today that now any manager, based on all those points, they can predict the outcomes, and they can even decide what are the trainings required for different managers based on their data-driven approach. Amazon, one of the companies we all know, bases all its decisions based on data. So friends, data-driven approach is something which is required. Deming once said, "In God we trust, others bring data." So the basic point of Deming was that whatever decisions we need to make, they should not be based only on gut instinct. It should have a data-driven approach behind it. And although if I really talk of many of the people, you'll find saying that the most important thing in business is what you call as intuition or gut instinct. But gut instinct alone won't serve in today's world. So that gut instinct has to be supplemented with the data. So that is what data-driven approach is about. It is about using your instinct, but then that instinct has to be supported by some kind of data. Okay. Now, as I said, companies like Amazon, like Google, like Starbucks, I've given you some examples, regularly use data for taking any kind of decision. Because as Saurabh said, the data is the new oil. And there is huge and quintillions of GB and terabytes of data which is there. So most important thing, as Nandaji also said, is data which is relevant for us. So for any kind of decision making, you'll find a glut of data. But the key is to create information out of it, to create some kind of wisdom out of it. Now for that, what you need is some kind of analysis. This analysis could be based on some kind of visualizations, could be based on patterns, could be based on trends, could be based on ratio analysis. Because today for each decision, there are so many data points which you somehow need to look at patterns. You need to look at the correlations between the data. Only then you could take a sound decision. Although we got people like Steve Jobs saying that the most critical thing is intuition. That is the most important thing. But intuition or gut instinct without the data analysis, without the data-driven approach, means nothing. And once you are able to analyze the data to support your intuition or gut instinct or support any decision, then one thing is definite is you'll have more confidence. Okay, and this has even been proven by Fortune 1000 companies. So Harvard Business Review conducted a survey of Fortune 1000 companies, and what they found was all those companies which had taken a data-driven approach were able to reduce the cost, enhancing their earnings. Okay, because once you know where my costs are, you can reduce it. Okay, as Nanda said, important thing is metrics. Okay, management system says what cannot be measured cannot be managed. So when you talk of management, most important thing is metrics. And for these metrics, what you need is analyze your data. Okay, so you can manage something only when you can analyze the data, get some data points based on it which you could work, and you could increase your revenues or you could decrease your cost, ultimately increasing your earnings. Because the bottom line for any organization is how to increase its earnings. And for any kind of decision, data analytic approach is very, very important today. And today we got so many of these tools which we can use. Okay, probably Ma'am Sangeeta would be talking about those tools, which give you some kind of patterns, which give you some kind of visualizations, which could give you some kind of trend analysis. Okay, because today it is about analyzing the data, not only financial data. It could also be non-financial data, right? So it is like I give you the example of Starbucks. The Starbucks not only measures the financial data, it also measures what is the traffic flow for a location, what is the demographics, what is the ethnicity of the place. So looking at all these different data points, it is able to take a decision whether to open the store or not. So they are also taking the help of a lot of companies which are into these kind of things. So they are using those geographical information systems to see where their stores are located, and what are the different data points which they get, which they can correlate again to get an insight into what would be the profitability. Now, the benefits of data-driven approach, one we already discussed is more confidence in our decisions. Because if our decisions are based on gut instinct, you as a board can't explain it. It is I would say very, very difficult to explain as a board that I am basing this decision on my gut instinct. But if we can supplement that gut instinct with some kind of data analysis, then there is more confidence on it. There is more transparency to the things. Second thing is that you can become more proactive. Okay, so once you have that data, then you can be proactive in a way that you can base your decisions, which are I mean, so based on some kind of data analysis. You can predict the problems earlier because now you have the data. Wherever the problems are going to come, so you can, with the help of data, with the help of patterns, okay, you can do it fast. Okay, so the approach to data-driven decision making helps you become more proactive, and that way also you can realize cost savings. As I said, HBR has conducted a survey where it found that the companies which used a database decision making were able to realize more profits, okay, get better revenues, decrease their costs. Now, once you get the habit of using data, then everywhere probably you'll be looking at data. You'll be looking at patterns. Okay, because patterns are everywhere. Nature is full of numbers. Nature is full of patterns. The only thing is we need to have the ability to look at those patterns. And when you look at these patterns, okay, you get a lot of information. Okay, like probably some of you would have heard the numbers like Fibonacci numbers. Now Fibonacci numbers are a series which is 0 plus 1 and 2 and 3 and 5. Now when you look at the patterns in nature, when Turing looked at the nature also, he realized that nature is full of these patterns. He realized that the petals of a flower, there'll be either one petal or two petals or three petals or five petals or probably eight petals. Means again, patterns everywhere. So these patterns you got to look at. Based on the patterns, you can predict, you can be proactive. Now, second important tool which is used in in a in a data-driven approach is the visualizations, the charts. Okay. Okay. In stock market, you would have seen most of the people are using what? Some kind of candle charts or some kind of patterns which are there. So that visualization gives you a very, very good insight into what the data is about. And decision strengths, if they are based on data, carry more value and most likely are to be more effective decisions which could help in growth of the company. Now the time is ripe that we become part of it. Okay, one thing which is very, very important is probably some of you would have looked at. There was a World Economic Forum job outlook. So this job outlook said that the top growing area would be what? Would be data analysis. They'll be having the growth, they will be having the value. So we as chartered accountants should become part of this community who can analyze data and help the corporates in taking sound decisions, effective decisions, which can help them grow. Because one thing, friends, is I always believe in: you give value, you get value. And the organizations can derive their value out of data analysis if they base their decisions on some kind of data analysis, some kind of data points which could aid them in the growth. So with those words, we have a very eminent speaker amongst us, Dr. Sangeeta Pandit. And I'm so thankful to you for inviting me to this virtual event, and off to Saurabh, so that we could hear to the eminent faculty here, Mrs. Sangeeta Pandit.
Thank you, Mehta Sahab, for a very scintillating and mind-intriguing presentation. Now you have set the tone, and Madam Sangeeta will take it forward. Great. Thank you so much.
Okay, so thank you so much, Mehta sir. You put it out really beautifully and so simply that even a naive man could understood it very, very, very easily. So moving forward, we have with us CA Dr. Sangeeta Panditji, who is the eminent speaker for today. So to give a brief about ma'am, Sangeeta Panditji was a partner in a chartered accountancy firm of repute from 1984. She retired and diversified to teaching and training. She is head of Department of Finance at the Premier B School, Sydenham Management Institute. She is also visiting faculty at B School of Repute like Xavier's and JBIMS. She gives guest lectures at US universities. She was part of startup team of Management Institute's United World School of Businesses and programs of Bombay Stock Exchange. She is an accredited cancer patient counselor and obtained her PhD in issues relating to healthcare. She works closely with various bodies for financial inclusion. She is an independent director in listed companies. She has many publications to her credit in reputed academic journals, written chapters of books by international reputed publishers, and has presented papers in international and national management conferences. She is a popular corporate trainer in issues relating to finance and soft skills. Ma'am, we are really delighted to have you with us, and the stage is all yours, and we are all yours. Over to you, ma'am.
Thank you, Saurabh, for the kind words. Actually, my work has become very easy because half of what I wanted to speak is spoken by Chairman Sir and Manmeet Singh Sir. Okay, allow me to open my PPT, please. Okay, Saurabh, is the PPT visible?
Yes, madam. Very
Yes,
much.
ma'am.
Very much.
Yes, ma'am.
Okay, thank you. So the topic given to me is Management Accounting Insights, Data Analysis for Corporate Decision Making. So let's touch upon what is management accounting, what is data analysis, and what is corporate decision making. Okay. Management functions. Now let us all imagine that we are in top management, the CEO and CFOs of an organization. So what is done in an organization? There is planning, then implementation of those plans, then maybe coordinations of that implementation and controlling the activity. So at every stage we have to take decisions. And normally decisions are taken as per standard operating processes laid down in the organization. There are user manuals. There are how decisions have to be taken, and that is, you can say, to some extent corporate governance, because corporate governance is not only complying with the relevant laws but also complying with the policies, processes, rules set by your own organization. So management has to take innumerable decisions. So let us now consider three main decisions: capital structure decisions, capex, and working capital decision. Okay, so in capital structure decision, what is the key is the weights that we give to the two sources, the debt and the equity, because maybe a debt equity ratio of 1:2 will make your value of your organization say 50 lakhs, but a debt equity ratio of 1:3 will make the value of an organization 70 lakhs. So how do you arrive at that ratio which will give you the minimum cost of capital and the maximum value to your organization? So you have the academic perspective, you have four basic theories. The net income approach theory says that as you keep increasing the debt content in your organization, the cost of capital decreases and the value of your organization apparently goes up. And you have a net operating income theory which says just the reverse. It says that as the debt content increases, or whatever be the equity content, your overall cost of capital remains the same. And so also the Modigliani and Miller approach, it is also called the irrelevance theory, which says it makes no difference how much is your debt or how much is your equity. Your overall capitalization rate will remain the same and your value of your organization remains the same, because they say that as debt content increases, the risk profile of your organization increases and the equity expectation also goes up. And then the benefits of increasing debt and reducing value of that organization is offset by the increase in expectations of the equity shareholders. Of course, in the Modigliani and Miller approach, they also bring in behavioral aspects of the investors. And the traditional approach is a more moderate approach. It says that, yes, debt in a capital structure is very important. It gives you the benefits of financial leverage, but only to some extent. Now, you have to look at things holistically. If you are taking a capital structure decision, you cannot only look at the sources of debt available to you or the possibility of the success of an IPO or an FPO. You have to look at the whole picture. Now, I'm sure all of you may have heard that story of 6 blind men who came across an elephant. Like one blind man touches the body of the elephant and says it's a wall, another touches the tusk and says it's a spear, another touches the the ears and says it's a fan, another touches the leg and says it's a tree, another trunk of a tree, like another touches the tail and says it's like a rope. So and one touches the ear and says it's a fan or something. So all the 6 were right in their own way, but if they had put it all together, they would have come to the right answer. So you cannot look at a problem in an organization in silo, though that is your department or that is the job given to you. You have to look at it holistically. So these are a 10 framework which many consultants follow when they go taking a capital structure decision. And generally you cannot go wrong if you have these 10 points on your table when you're doing a capital structure consultancy. The nature of the industry, of course, whether it's manufacturing, trade or service sector. Your operating leverage, you should know how much is the fixed cost element in your cost structure. Whether your organization is asset light, to what extent it is, because that would depend on how much loans you can take. The elasticity of price of your product which you're selling, because there is a limit then to how much you can increase the selling price to increase your revenue. the elasticity of the price of your raw material. So how much can you negotiate with your vendors? And these 5 forces of Porter will always help you to come to better decisions. You have to know today where you stand in the competition space. What is the power that the buyers have over you and the suppliers have over you? What is their bargaining power over you? What is the threat of substitutes which will enter the market for the product that you are dealing with? And how high or low are the barriers of entry of people entering your sphere, your way of your area of business? So this 5 forces of Porter analysis have to be done before any major decision. Of course, there are company other features like your reputation, your branding, your attrition rate, at what rate employees are leaving you. Credit rating, it is very interesting that when you go for a bond issue, and most of the bond investors will rely on the credit rating given by credit rating agencies, and it is only in equity investments that people go in for aggressive equity analysis. Working capital features of the organization, because astute working capital can really keep an organization floating even in traumatic times. And it is when you don't have good working capital management that you really flounder. And of course, you need a consultant's opinion for important decisions, because, like a surgeon will never operate on his own child or her own child, because your emotions are involved. Maybe it's not possible for you to take a aloof, pragmatic, third-party view. So you can take a consultant's opinion, but remember, you have to customize it to your environment. Profit analysis, that is extremely important. You have your DuPont analysis, which is a very beautiful analysis, that is net profit upon sales, and then you multiply it with your asset turnover ratio, that is your total assets you have. The sales is the numerator and the assets employed is your denominator. So you understand how much sales have been generated from your assets. So net profit ratio multiplied by your asset turnover ratio gives you your ROA, the return on your assets. This you multiply it with your total assets which you have employed in the business, which will be the numerator, and the denominator would be your equity financing. So you know the leverage, how much of your financing is done through equity. So that will give you a ROE. So this is a wonderful analysis which tells you that are you doing good because of high sales or low costs, or better efficiency of your use of your assets, or is it because of getting the benefits of financial leverage? So you know where your strength is, and then it's very easy for you to do your SWOT analysis. What are your strengths? What are your weaknesses? And which are the opportunities that you should take advantage of, benefit of, and which are the opportunities you don't take benefit of? Just because there's an opportunity in the market, your business cannot take benefit of it. You should have the strength to do it. Every top CFO or CEO knows the point of indifference of the organization, the EBIT level, till when it makes no difference whether you go in for equity or you go in for debt. So till that point, there is no point in going for debt and increasing the risk profile of your organization. Your coverage ratios, meaning your, say, interest coverage ratio. So if your EBIT is 50,000 and your interest is, say, 30,000, so you have a buffer of 20,000. Or your debt service coverage ratio, meaning your cash flows or your cash balance after all operating expenses is, say, 1 lakh, and your EMI, your principal plus interest payment, is 70,000. So you have a buffer of 30,000. Is that adequate? Okay, and liquidity. Cash is king. I mean, we have seen in this pandemic times, it is those organizations which had astute cash management could remain floating and get over the first lockdown, second lockdown also, and have prospects of being in the long term a profitable organization. They could manage to carry on without much layoffs or asking people to leave the organization. So cash flow statement analysis is very important. You have to keep doing it quarterly or monthly, or cash is king actually. And cash budgets need to be prepared. Sensitivity analysis, scenario analysis is constantly done, has to be done. Sensitivity analysis, when you make projections based on certain parameters, and then you try to understand what will be the impact on the decision that you have taken if one of the parameters you tweak. And scenario analysis, when you tweak all the parameters, considering an economy to be in a boom stage or going a bad stage or being a say moderate stage or the stagnation stage. So these are, we have learned them academically when we did our final CA, but in the industry they're actually done. Okay. Also, your capital structure to a great extent depends upon how much control your promoters or want on the company. Like generally, lenders and creditors cannot take part in major decisions in the day-to-day activities. Maybe preference shareholders have lesser than equity shareholders. So maybe the mix of capital structure would also depend upon the promoter's attitude and towards the control issue. And timing, that is very, very important. We all have witnessed fundamentally strong IPOs not doing well and IPOs not that fundamentally strong, being oversubscribed many times. So when will you go in for an IPO, FPO, the time or the right issue? The timing is very, very important. Or also when you have to understand the macroeconomic environment, the impact of monetary policy and the macro. They say it is called Pestle analysis, and that is very essential for any organization to do, that you have to know what is the political situation in your country and all over the world, what is the economic condition, position of your country and the international position, what is the social fabric happening, what are the technical leaps happening, and generally what is the legal environment and the economic environment as it comes to climate change and all. Because in the long run, that is going to give the direction of your organization. It is going to impact your bottom lines in the long run. And at top management, you always take a macro view, a long run vision. You are not taking decisions which will, you think it's a decision which is going to give you returns today and tomorrow. You're thinking of decisions which will give you sustainable returns over a period of time. Because that is why your decisions should always look at a long-term perspective. And for that, Pestle analysis is extremely important. Okay. You have to take a holistic view. Okay, for when you go in for debt, you have the tax shield, interest is a deductible expenditure. You may shift to places where you get a better subsidy or tax holiday or something. You may take benefit of all the government schemes, like you have the production linked incentive scheme and all that. But you have to take a holistic view and not only go in for activities or areas or planning in such a way that just for tax reduction. It should ultimately benefit the organization and benefit all the stakeholders in the value chain. So in the value chain, you have vendors who are supplying you goods, you have customers who are buying your goods, employees who are depending on you for their salaries, you have the society to which you are contributing by way of pollution and all, you have to reduce that. You have the government to which you are giving taxes. So you have to consider all the stakeholders and behave and take your decisions in such a way that you balance all the stakeholders' expectations, because they are the people who are going to support you in times of trauma, in times of difficulties. So if you support them always, that the long-term sustainability of the organization will always be there. If your employees are not happy, someone gives you a better salary, they're going to jump there. If vendors are not happy, someone gives a better competitive rate, they're going to jump there. So business is a lot about qualitative factors. It is a lot about building strong relationships with everybody. So we all know financial leverage is when your earnings per share goes up more in proportion to the increase in earnings because you have debt content in your capital structure. The simple logic is that you buy assets with what loan you have taken. The return from those assets must be more from the interest that you're paying for that loan. There is another theory called the pecking order theory, which says that to be on the safer side, go in for your retained earnings, go in for internal financing first, then think of debt, and finally think of equity, so that your control is not diluted much. But again, this theory works only if you have plenty of quality information available with you. Then there is a conservation of value principle in capital structure, which says that two halves must make a whole. Meaning, if you have a cake and you cut it into two parts and join those two parts, again it should become a whole cake. But if you eat some parts and join it, it is not going to become whole. So logically, debt and equity, whatever be the ratio, if you join them, it should not impact the value of the firm. But what happens? These parts are eaten away, just as you've eaten away the part of the cake. They are eaten away by, say, colored judgments. You take decisions in your organization due to bias. So we don't realize, but we have a bias in our minds, some prejudice in our minds. There is some bad mismanagement of something, which may not be a fraud, but it is just that we didn't take the right decisions, the prudent decisions, and they have eaten away the parts. So very simplistically, this is the chart which I always keep before me, is that when do you take a loan? Only if the rate of interest is lower than the rate of return from the investment. And let me tell you, very often people don't do that. Just because a loan is available, they are so excited, and people who have liquidity with them use a lovely marketing strategy to offload the money on you. And why are you taking the loan? If you are taking the loan for expansion, and you have to have proper surveys that if there is a market for that increased activity, and you're not going in just because you have the strength. You have a machine which has 20,000 capacity and you are producing only 15,000. So then why not increase that and go for full capacity? But is there a market for that extra units? And then are you doing it for your M&A activities? Do you need some funds to buy some brand or some activity or some smaller organization? And we all know that most of the M&As, more than 60%, they are failed M&As. The synergy doesn't happen after the M&A. So you have to be mindful of what they say is the hubris syndrome, the winner's curse, that just because you have started an activity, you go in for that. You say so much time and effort you have put in, it becomes an ego issue, because times change and maybe what parameters you have considered have changed, and today it may not be the right time to go in for the M&A. So always be aware when you are in top management of the hubris syndrome, the winner's curse they call it. Very often we go in for debt finance to pay off our old loans, but remember, what is the relationship that you're going to have with the new lender? So maybe the old lender would have looked the other way if you had defaulted in 2 days or 3 days to pay off your loan. So that goodwill is required to come back you need to have a lot of goodwill in business. And from where are you taking? I know I have been independent director, as they said, and there people don't question. They say, paisa to aa raha hai na, why are we bothered? We have not earned it. But the source of fund also has to be the right source, otherwise it will come back to haunt you if it is not a good source. And you have to consider issues, of course, of equity, P, and hiving of an activity also, because an opportunity cost has to be understood. The concept of opportunity cost is very important in business, that if this money which you have invested in business is going to give you better return somewhere else, then you need to hive off that activity. And of course, the optimum level of debt and equity, that you have quantitative tools like your break-even EBIT point, where you have the formula, which now with Excel tools and all, it is easy to calculate. You have your cash flow projections, your market share, and of course, qualitative analysis is very, very important. Like if you're going in for debt, there should not be so much pressure on the people to maintain liquidity to pay the interest that nervousness impacts their productivity. So that is your capital structure decisions. Then another important decision that you take in business is your CapEx decision. The money that you raise, you put in long-term investments. Now, one thing one has to remember, that all your investments, whether you go in for not, It has to be aligned with your goal, mission, and vision of the company. It cannot be just some idea of some head of some department because he has heard a competitor doing that activity, because he is read in the papers that there is a market for this product. You cannot go in for that investment. It has to be aligned with your goal, with your mission and vision of the company. See, the mission, the vision, and the goal of the company is set at the commencement of the company, before the company is incorporated. And that is the reason, that is the purpose you are in business. Now, if you want to do something which is not aligned with it, you have to relook at it and not be in a hurry. Then change your mission, change your vision of the organization, because these are long term and you can't go against it. It is just like your portfolio manager. You give your money to manage your portfolio, and you have arrived at an understanding that that person will not do trading. Now that portfolio manager cannot say that this is an excellent opportunity for trading. I have a tip which tells me that this stock is going to go up. I will buy it, and by the end of the day, it's going to go further up, and my client will make a lot of money. No, he cannot do that because the contract doesn't say so. So he has to redraft the contract. Only then he can take the action. Similarly, no action should be taken in the company if it is not as per the goal of the organization, mission and vision statement of the organization. And it is tough to take these decisions because the benefits flowing from the investment are in the future and they come over a period of time, while the outflow is now. And why these are irreversible decisions to some extent. Like you cannot buy a machine of say 5 crores and say after 5 days that I think this was a wrong decision, let's just sell it off. It impacts your profitability, your efficiency, your competitive position, and it can, create future profits of your business and put your business on a growth trend or on sustainable trend, or bring it a downfall, because this new capex may subsidize the profits which you're doing as of now. And they're based on estimates, and the estimates are future, and of course they are tough to predict the future. And then qualitative factors have to be considered, just as in capex you consider the qualitative factors here too. Okay, everything says you should buy a machine, but are your workers ready for it? Are they going to resist that machine? Do they have the skill sets for that? If they don't have the skill sets, are you going to employ new workers who can also do the old workers' job? And so are you going to lay off the old workers? So these are so many issues you have to look at. As I say, you have to look at things at 360 degrees, that in a holistic way and not in silo at one issue. So capex, they will either result in increase of revenues or they will result in decrease of costs or both. But generally those capex which goes to increase revenue more than decreasing costs, those estimates are tougher than just cost saving capex. And the steps in capex is, of course, you ideate and you draft a proposal and make a presentation to the board or to the head of your department saying that you want it. Then you evaluate the proposal, you select whether you go in for it or not, then you implement, and then there is the follow-up. And of course, in capex, you consider only cash flows and you consider time value concept. What is time value concept? That your cash flows you divide by your DCF. Why do you do that? See, like if you have 5,000 euros and $3,000, you don't say you have 8,000 units of currency. Similarly, from a machine, if you're going to produce goods and from the sales earn a revenue of 1 lakh every year, the 1 lakh you earn in year 1 is different from the 1 lakh you earn in year 2, and that 1 lakh you earn in year 3 is different. You can't add them all together, because what you earn in 1 lakh after the end of 1 year, what you can buy for 1 lakh then, you can buy today for same thing for 98,000. What you earn 1 lakh in 2 years, in the second year, if what you can buy in the second year for 1 lakh, today maybe you can buy it for 97,000. And that is why you have to bring everything on the same platform and you discount it with the DCF factor. A businessman will always look at decisions when he takes a post-tax and in the present discounted value, present value way, not in the compounding value way. Of course, you have the Schedule 3 to Schedule 2 to the Companies Act of the depreciation, then you'll have format given in Schedule 3. But for capex decisions, you will look at the cash position, you will consider your profit before tax, reduce your tax, and then come to your cash profits by adding depreciation and all your non-cash expenses. Existing fixed costs you will ignore, because fixed costs are those costs you're going to incur whether or not you go in for the new activity, so you have to ignore. You only consider the additional cost or the incremental cost. And irrelevant expenditure are not considered. Like, I can give you an example. In the good old times, pre-pandemic, when we used to roam around and travel, suppose your friend and you went for an exhibition and spent 500 rupees to go there and spent 1 hour to go there. And after you reach the exhibition, there is nothing worthwhile buying. So your friend says that, "Arey, itna kharcha kiya, waqt bhi chala gaya, so let's buy something." But no, if you're logical, you will say, whether we buy or we don't buy, the time we have spent and the money we have spent is gone. So that is called sunk cost, and that is irrelevant in expenditure, which you will not consider while taking capex expense. Then of course you have kinds of capex proposals which will come to you as a top. If you are part of the top management, you have independent proposals, meaning it's a singular proposal which the organization wants to go in for. You have dependent proposals, meaning a proposal, say, to put up a factory, then you have to put the road to the factory also. Mutually exclusive, like you have proposal for purchase of 2 machines, but both do the same work, so you have to buy only one of them. Very often you come across which when you have to take the decision of replacement of the old equipment. So you have to know what are the proceeds we will get from the sale of old equipment, what are the costs which will get reduced because now you are not going to use the old equipment, and what are the new costs for the new equipment. Because there would be certain facilities which you will not have to create, which are already there because of the old equipment. And of course, these are the 4 standard methods: the payback period, the time when you get back your money; NPV analysis, which I referred to, where your cash flows you divide by the DCF factor. And what is basically a DCF factor? See, when you make an investment, or you take an example, say, you have 8 lakhs with you today, and you want to buy a car, but you say, no, today I will not buy. I will buy after 2 years. So you invest that 8 lakhs. So what have you done? You have sacrificed your present consumption for future consumption. So there is a return which you want for your sacrifice. So after waiting for 2 years, you say, I would like to buy a better car, which costs, say, 8,20,000 or 8,50,000. So you want a return from your investment of 50,000. Now after 2 years, that better car of 8,50,000 is going to cost you 8,60,000 because of inflation. So you want a return of 10,000 more. So 50,000 plus 10,000. So your 50,000 is your pure rate of interest, your real rate of interest, and 10,000 is to cover the inflation aspect, and that is called the nominal return. And now you have waited for 2 years, and there is a risk. Maybe today the car has not yet picked traction in the market. It is easily available, but after 2 years, it becomes very popular. The demand is more than the supply, and you don't get the color of the car that you wanted or some features in the car which you wanted. So you are taking a risk with waiting. So higher the risk, more is the return you want. So that is the third factor. So these 3 factors go to decide, and that is how DCF is calculated by the finance department. And the cash flows are discounted with it. Internal rate of return is the rate where your inflows and outflows match. And profitability index, you should not ignore small projects also which are going to hamper the efficiency of your organization if you don't do them. So just to remove to bring up the same platform projects which are of big amounts and smaller amounts, you to find profitability index and go in for the project. If it's more than 1, you divide your inflows with your outflows. Then the last important decision that we take is your working capital decision. So that is mostly taken as per your ratios, your turnover ratio. So what is your debtors turnover ratio? Where you divide your turnover with average debtors, your opening plus closing minus divide by 2. So suppose you get a ratio of 4. 360 by 4 will give you your debtor cycle. So that is the average credit you are giving your customers. So you compare it with the average credit your competitors are giving you. Are you unnecessarily giving more credit? Or you do simulation exercises and see that you are giving 4 months credit. By giving 5 months credit, by giving 3 months credit, would the sale level remain the same? So are you unnecessarily giving more credit to your customers? You can find the creditor cycle by dividing the cost of goods sold with the average creditors. So you understand, suppose that is 3. 360 by 3 gives you your creditor cycle. So you understand how many days on an average your vendors are giving you. You compare it what your competitors are giving you. Are you failing in your negotiation with your creditors and they're giving you less credit? Ideal way is to get credit from your, receive money from your customers and pay it to your vendors. And today, if you see the SME and the MSME sector is contributing a lot to the GDP, and the numbers are increasing by leaps and bounds. And then if you see the ratios of the MSMEs, it's more of trading MSMEs. And here, this debtors creditor cycle becomes very, very important. That the period of credit they get from their creditors should always be more than the period of credit they give their customers. Then your stock turnover ratio, whatever is your cost of goods sold, you divide by your stock balance. So that is probably the average time your stock remains in the godown. If it's raw material before it is sent for production, if it is finished goods before it is sent to the godowns. So why do you clutter your godown? You have to have your quantitative analysis of EOQ model when you know your reserve stock, when you know the lead time and all. And you have to be practical in your stock management. The most simple theory is the ABC analysis. And I can tell you a true story. When I was in college, in our group, there was one person whose father owned a Udupi hotel in Bombay. Very rich boy compared to everybody. He used to stay just a stone's throw from the college, but he used to come in a car. Fancy imported wristwatch he used to wear, and gold chain and everything, and spend money also very easily. So one day we asked him, how come your father's hotel is doing so well? So he said, see, my father uses common sense, it's a simple, ordinary second grade Udupi hotel, where it is so crowded that when you are eating, somebody is standing behind you, so that you vacate the seat. And he's saying, see, my father sits on the galla, on the cash counter, and in the kitchen there is, sambar, rasam, idli, coriander and all that, vegetables. So that is a lot of inventory is there, but that doesn't comprise much of the value of the inventory. So he turns a blind eye. The waiters waste, they drop, they consume, they eat, they if their friend or somebody comes, they will give little more. So he says he doesn't bother because he knows, okay, it doesn't comprise much of my value of inventory. Where he sits in his control is cashew nuts, dahi vada, ice cream, Nescafe powder and all that. Full control. That is only about 5% of the inventory, but it is 80% of the value. And this 80-20 rule always works in life. So in any business go down, if you go to see, 80% of the goods comprise only 5% of the value, and it is 5% of the goods which comprise 80% of the value. So you have to be practical and keep the employee motivated, and don't make an issue of small things. Always in life be penny wise and don't be pound foolish, they say. And to come back to cash balance, astute cash balance management is very, very important. You cannot ignore preparing cash budgets and periodically preparing cash flow statements. When you do analysis of P&L and balance sheet, it is equally important to do analysis of your cash management. So these are the important points of maybe the important decisions that you take in corporate life, in the corporate world, in an organization. As I said, you take innumerable decisions, but I have just discussed 3 important decisions. And then there are certain issues which I would like to touch on. One is management by exception, meaning in the corporate world you have something called standard costing or preparation of budgets. So what is standard costing? You have a standard cost set for the raw material that you're going to buy, or the rate at which you're going to pay the laborers and all. So you compare actually what you have spent with the standard cost, or you prepare budgets and compare actually your actual figures with your budgeted figures and find out the variances. So you generally focus on the variances, and that is management by exception. Where you're going wrong, you understand your weaknesses. So work on that, and if you feel you cannot develop the strength for it, you hive off that activity. But very often, by human nature, we go in denial and we just block off what we are not doing correct and go pursue things which are going well. In fact, they say success has many fathers. So all attention goes to things which are doing well, and what is doing well also gets messed up. So you have to understand the concept of management by exception. Then management by objectives. If you want to do things well and be success, business has to do well. The targets, the budgets, everything has to be set by including the people. Like a sales target, if it is to be set, you have to consider the opinion of the person, of the salesman on the street, of the people who are bringing in the money, who are sales, who are locally there stationed, the branch office people and all. So, and when they help you to set the targets, they are more enthused, more passionate to meet the targets. And of course, winner's curse, hubris syndrome, I've touched upon, which is very, very true in the business world, that people take up a project, and just because they have spent a lot of time, a lot of effort on that, and they are identified with that project, they are scared to let go, even though it's going to not be good for the organization. And that leads to bad synergy after any project. Particularly, synergy is the word used for post M&A benefits. And strategy. I would recommend you to Google Mintzberg's strategy safari. There are 10 schools of thoughts, and I mean, you cannot be using that one school of thought only, maybe a combination. But business success is not an accident. It is very much thought of because of good strategies adopted by the management. So whether it is a learning strategy, meaning you learn from your past mistakes, not only yours, your competitors' mistakes also. Whether it is, say, cognitive strategy, where you use a lot of HR skills to keep your employees motivated. So there are different strategies which an organization uses. And of course, landmines and financial statements. I don't have to speak about this with an audience of today, like closing stock or lease and sale back and all these such kinds you have to be mindful of. Ratio analysis is very aggressively used and very, very important. Marginal costing, where you focus only on variable costs and take important decisions like pricing, your mix of products. Activity-based costing, where you know whether the resources you're using is justifiable. And today, when businesses are global, you have to keep tabs on the exchange rates. And again, as I told you, 80-20 rules applies. In every sector, 20% are the big players who will influence your organization. So you have to be mindful of that. Today's government policy, the future government policy, what could be. And as the previous eminent speakers touched upon, culture and leadership. What is culture? Very, very subconsciously, subtly, it gets developed into an organization. In fact, today you have organizations like Monitor and all doing cultural audit. They try to identify drivers which are bringing down the productivity of an organization or impacting the bottom line of the organization, and identifying the drivers which are raking in the money. So you try to, and then they try to influence the culture of the organization in such a way that it becomes positive, which will increase the bottom line. So what are the negative things in the culture of the organization which are bringing down the productivity? Because people are different. In a certain country, people may be having a certain personality. People coming from a certain state may be having a certain personality. There's nothing wrong in that personality. Some people like to follow rules. Some people like to think out of the box. Some people are hardworking, while some people are not at all hardworking but very creative. So a culture should be such which is good for the type of people which you need for a particular type of job. And leadership also. It is very easy to lay down the traits of leadership. Everybody knows what a leader should be. but which trait you should be more mindful of when you're doing which job. Like certain jobs need to be worked in teams, while certain jobs need to be worked in silo, alone. Sometimes you need to have an aggressive leadership style. Sometimes you need to have a more persuasive style. So good leader is one who has the wisdom to understand how to switch styles, which style to use at which situation. So coming back to what I said in the first slide, that in an organization, the management does many functions. You can bring it down to planning, implementing, coordinating, and controlling. But the commonality is that everything involves decision making, and decision making has to be prudent. And how do you make decision making prudent? Is if it is based on data. Like the previous speaker Manpreet sir also said, that decisions taken on data are far more prudent than decisions just taken. And how do you do data? How do you go to the way you go about taking decisions by using data? You have data of two types. One is primary data and the other is secondary data. What is primary data? That is raw data you collect, which is not existing data. It is not data available on public domain. It is not data which is historical, your past performance data of your organization. It is actual real time data which is never been collected. And you are going to take decisions of the future. So you need the real time data. So today, who are your customers? Today, what are your issues? Maybe by questionnaire method, maybe by interview method, whatever method you take, you have to have primary data with you. Like suppose you're going in for a, say, capex, you're going in to buy a machinery. So what would be your primary data? On public domain, everything is available. But your primary data would be, you would go to, say, 5 other similar organizations and somehow make a survey as to which machines they are using and what is their feedback about those machines. That may not be available on public domain, or no dealer will tell you that. Secondary data is what is already available. You have to use what is already available. So both these data, you analyze them. And how do you analyze them? One is called descriptive analysis, where you use statistical tools like your measures of frequency. How frequently has it happened? How frequently has somebody visited your website? Or you use central tendency, your mean and mode. You use dispersion. You use position, your median analysis and all. So that is descriptive analysis, using statistical tools to understand the data. Inferential analysis is what you use the analysis of a particular sample and infer that as to the features of the population that you're dealing with. We have all done that in stock taking. It is not possible to take entire stock taking, so we take stock taking of a sample and try to infer the nature of the entire stock. So inferential analysis is done. Then predictive analysis is something where we are today. And that is now the raging subject today. That with data, you do predictive analysis, you try to estimate or you project what is going to happen in the future. So you stop something happening. Like, suppose you are going on a flight and what are the risk factors that will cause a crash? Predictive analysis will see that the crash does not happen. Forensic would be what? If the crash happens, then why did it happen? So predictive is the field today, which is a very exciting area where you prevent things from happening if it's a fraud or an error. You help marketing with your, say, analysis. If you are going to touch a target of 10,000 units, with your analysis, maybe you will touch a target of 20,000 or 15,000 units. Operations. How do you reduce the risk in your operations? How do you reduce the cost in your operations? You always had risk committees, risk matrices in your organization. You know which were the high risk areas. In internal audit, we did high risk areas, low risk areas, and how much time to spend on the high risk areas and all. But predictive analysis will tell you what is the probability that the risk will occur and how do you mitigate it. Then of course, causal analysis, the cause and effect, that something happens, and because of that, this is going to happen, the snowballing effect of certain happenings. And a nexus between two, like maybe that if our say our capital content from 50 lakhs becomes 60 lakhs, what would be the effect of that? Our bottom line will increase, say from 33 lakhs to 48 lakhs. So then we try to analyze whether this cause and effect that we are predicting, we are thinking is actually right by doing the data analysis. Mechanistic analysis is more in manufacturing or in research, like say in pharma research, the molecular research you do, that this tweaking this molecule or changing this molecule is going to change this, or in gears, if you increase this gear or decrease the size of this gear, so changing some variables is going to have an exact change in the other. So these are various analysis you do, types, maybe a combination of these types also, and the statistical tools that you use, maybe SPSS, R, and there are many others. Python is one of the newer languages which is becoming very popular. Now let me tell you that as consultants, or even if you are working in industry, we need not have a mental block on this technology part. We have to have our concepts clear, and it is the IT team who will give us the technology support, because technology is not something we should become a slave to. It is something which is going to enable us in our working. And we have brilliant minds who are looking after that maybe we can read a little bit about it, maybe do a few courses on that to get a basic understanding about it, but we need not deep dive into that. Then you have machine learning and AI. Machine learning is where the machines are programmed to automatically create algorithms according to the data that they take. And AI is they intelligently process the data. But let me tell you again, the most important point is that all this analysis may be done by technology. The type of analysis also would depend on what type you want analysis to be done. That would be done by technology. But ultimately, the decision is to be taken by you. Just like a consultant may give you an opinion, but the decision has to be taken by you, to what extent you follow that opinion. Similarly, to what extent you follow this decision depends on a human being. And very often, decision is your state of mind. And state of mind is a very complex subject. I mean, a lot of neuroscience is also involved in that. And today you have a lot of, the CEO trainings going on, where concepts from neuroscience are considered. They say a brain has 5 parts, and which part you have to use when you should know. And you have a part, the primal part, which reacts with anger, and you have ego issues there. Then you have a part which stores information. So you have the fifth part which keeps all these 4 parts in balance and all. So your state of mind is very, very important, at least when you're taking important decisions of your organization, like capital structure, capex, or working capital. Your state of mind, when you have the results before you, has to be good. You have to be aloof, you have to be pragmatic, you have to be balanced. And they say it is genuinely done today by top CEOs and CFOs of Fortune 100 companies, that they do yoga, they do meditation, they do chanting, they play golf, they do singing or dancing or whatever works for them, to be distressed, to be in a proper state of mind, so that you take the prudent and decision, and so that your decision is not colored by any bias or ego issues or anger or disappointment or greed or fear or ambition or anything. You should be absolutely have clarity of thought and be very calm and balanced. And data-driven decisions are very, very superior, and research has proved it. Like, I think the earlier speaker touched on this. You please Google about this, the New Vantage Partners report in HBR, where they have proved that all decisions taken by organizations which are based on data are far superior to traditionally taken decisions. What are traditionally taken decisions in an organization? You have a meeting, people brainstorm on the meeting, you look at the past practices in your organization, you call for a consultant who may read your current balance financial statements of few years, previous years old financial statements, and give you an opinion, and finally you come to a decision. No, today you take decisions on big data analysis. About 2.5 quintillion bytes of data is generated each day, they say. 1 byte, I think, is 8 units, and 2.5 quintillion is million trillion bytes. 1 quintillion is million trillion, and 2.5, that much data is generated. So that is the power of the machines, that they can analyze this data so fast. And Manpreet sir also touched upon Project Oxygen of Google, where they collected data of all high-performing employees, and they understood what are the traits, what are the personality traits, and what are the practices of these employees, which is helping Google. And they designed their training sessions on them so that they have all high-performing employees. Walmart did it years ago when the machines were not that sophisticated. They took real-time stock data, and they used to understand at any given point of time what is the stock in every Walmart location, which are the stocks which are fast flying, and which are the stocks which are remaining in the shelves. So immediately they would declare sales for those stocks. So better sell off those stocks rather than make them obsolete. And which are the stocks which are going fast? They used to replenish those stocks. So that is how they maintained profits in spite of selling goods at a low price. I think Manpreet sir also touched upon Starbucks and Amazon. How Starbucks, a lot of their bottom line is because of their location. And they had hired an analytics company which did big data analysis on location-driven sales, how it would be. And Amazon, if you are shopping in Amazon, you will see that you will keep getting your past purchases and also their recommendation list considering your past purchases. This is a kind of AI, and 30% of their sales, they say, is because of this. It is very interesting about Quaker Oats also, what PepsiCo did years ago in US, how it has become a part of the life of the US citizens. They use Pep Walks, a tool wherein they did data analysis of huge population of US, and then they filtered and found out who would be the potential buyers, and then their preferences, needs, likes, age, and all that, and finally arrived at this what should be the color of this oats, what should be the packaging, what should be the size, and what should be the price, and then it started selling very well. It became a success product. So basically, there are, they say, 6 steps in data analysis. You have data cleaning, meaning you collect data. Like today, most organizations have either Oracle or SAP, SAP or something. So data is collected at various points. So you collect data from all points. You have primary data, you have secondary data, you have a lot of collection of data, but then you clean the data because some of it may be duplicate, some of it may be irrelevant, some of it may not be authenticated. You have to have factual data. So after data cleaning, then you ask the right questions. Why are you collecting the data? I mean, you don't collect data for data collection's sake. Like, I mean, if you've seen the movie Fiddler on the Roof, that man is singing, if I were a rich man, I would build a house with a staircase going here, staircase going there, and a staircase going just nowhere. So you can't be doing things just for collecting data because everybody is collecting data. From that data, you need to take some decision. So what are the right questions you ask in a decision? Like in CapEx, like in say capital structure decision, what would be the questions you ask? How much is the risk profile of your organization going to increase? Will you have the liquidity to pay the interest when the principal when the time comes? If it is equity, would you be in a position to meet the expectations of the shareholders? If it is capex, would that revenue from that asset be more than the amount you're putting in that asset? If it is working capital, is your stock balance, cash balance, inventory, or is the optimum balance so that you are the minimum amount is invested and the maximum sales you are managing? So you have to ask the right questions. And then after you have collected your data, you have cleaned the data, you've asked the right questions, then you have these visualizations, like you convert it into graphs, charts, images. You've all used Excel tools. You have those bar diagrams, you have pie diagrams, something like that. But today you have Microsoft tools, which are, some of them are free tools, which will make you do some more sophisticated visual 3D visuals and all. And let those charts then answer your questions, because then you will see from those visual tools some trends, some images, your strengths and weaknesses and all. And then you have your answers to your questions, and then you have to support your answers with qualitative factors. The qualitative factors is very, very important. It is not only the quant that gives you the answers. The morale of employees, the culture of an organization, the productivity is very much linked to that. I mean, okay, you have to have the right debt equity ratio. You have to make the prudent decisions regarding capex. You need to have proper working capital levels, but you also need to think deeper, go deeper, that are your employees satisfied? Is the attrition rate not very good? Like maybe in certain sectors, it is good to have a high attrition rate. People say, okay, leave. It's better that new people come in and look at things in a different way. So whatever is needed for your organization, you have to look at it look at the qualitative factors. Do you have the loyalty of your vendors, your customers, and how do you do cost management techniques without hurting the morale of your employees? How do you do decentralization? Because very often people feel decentralization is allowing functions to be done by others. Not everything should not be done in the head office. You should have branch officers also who carry out certain functions. But decentralization in the true sense is even where decision making is decentralized, even when decision making is allowed to be taken by managers of regional units, then they are enthused. They get a sense of importance and a sense of belonging to the organization. So qualitative factors is very, very important to make the employees feel a part of the organization, to give them importance so that they feel motivated to work better. And then if you Google, you will see that there are innumerable tools available. You have Autograph, Explain, Zoho, Sprinkle, HubSpot, Tableau. Microsoft has a lot of free tools also. But coming to almost to the end of my PPT, there are some universal concepts which you have to consider in spite of so much of technology, like weights. Like I told you, in capital structure, the weights have to be there. Similarly, in your portfolio management also, they say that proper weight has to be given to different asset classes, or even in your day, even in your personal life, how much weight you give in your day to different activities. So weights is very, very important. So when you're doing data analysis, you have to understand the weight that you give to every data which you're analyzing. So if it is you're analyzing to understand the revenues, you will obviously give more weight to the sales and to the raw material cost than to the other issues. So the weightage is very, very important to understand. And of course, the purpose. You don't outsource your data analysis to a technical organization, and then like say Accenture or Cognizant, and not telling them the purpose why you are doing it, because that purpose will determine the visuals that you create. And of course, in any activity that you do, there has to be primary data, there has to be secondary data. Like before today's presentation, I did speak to CEOs and CFOs of a 5 to 6 organization to understand how they take decisions. And so I arrived at, after chatting with them, that yeah, this is the 3 important decisions in any organization. And what are the issues that make them take the wrong decisions like? So primary data is always needed. And of course, secondary data is much necessary also, because it's already there. Somebody has done the research and it's freely available today. Today at your fingertip, you have so much of data that, I mean, 10 lives will not be sufficient to consume that data. So you have to do filtering a lot and understand and go to data only what is needed. Okay, Saurabh, I'm coming to the last slide. I think I finished much earlier. I would recommend reading this book, Principles of Corporate Finance. Sure, most of you may have gone through this. It's a wonderful book which gives you the basic concepts which will really make you understand what corporate finance is. And of course, there's another good book is Holmgren for management accounting. And I think one should invest in good books, just as you invest in shares or you invest in mutual funds or ETFs. You have to invest in good books, and it's not possible to read the book in 10 days, 15 days. You keep it for life and you keep referring to them transaction wise. Holmgren is an excellent book for management accounting. It gives you the principles of costing, of various types of costing like marginal costing, standard costing, target costing, activity-based costing, cost sheet, and how you can take important decisions like whether to accept an export order or not, whether to go in for offbeat order or not. And this data mining book is there. It's a simple book by Berry and Leinoff, which will give you an idea as to the kinds of data mining that you do. How do you, and you have words which they use, mining, lakes and all that. But that is just to, I think you don't have to get bogged down by the jargons. It is basically big data, which machines which have the ability to process that data. And then you have data mining techniques which help you to visualize that data in the way that you want to do it. So I feel that now we have new age CAs who have to look at this data mining issues, data analysis issues, and maybe the time has come when chartered accountants will not have to certify only that the books show a true and fair view of the affairs of the organization, but also whether the organization has been ethical in using data. Has the organization's source of data been ethical? We are all hearing this Pegasus issue on TV. So has the source of data been ethical? Has the use of data been ethical? Because it's wrong to influence a person. Like data can be misused. It can make, a pharmaceutical company can make a person an addict to sleeping tablets by wrong use of data and wrong marketing. Or company working in tobacco or liquor can make a person addicted to it, or you can make a person unnecessarily go on seeing content, or be on OTT platform when you need not be so much. It can impact your health. So are these data analytics being used for the wrong purpose? Basically, it should be used for nation building. It should be basically used to increase the GDP of the organization, for businessmen to more run the four wheels, factors of production. The four wheels, that is your land, labor, capital, enterprise, should be used more effectively and to increase their share in the GDP. So maybe a time has come for chartered accountants who play a big role in nation building to look at organizations, to encourage them to use data, because all said and done, decisions based on data are far superior to decisions taken traditionally. So and what data? It is big data analysis. It is using the various tools available today. I teach in a B school where students do finance as specialization, but most of them are from engineering background, and they have had work experience with organizations like Cognizant or Wipro or Infosys and all. So they understand technology, but they don't understand concepts. And in 2 years, you really can't teach them so much as chartered accountants have learned by exposure in their articleship and in the tough exams that they have given. So it's a very good combination what our CMA committee chairman Nanda sir just said, that chartered accountants are allowed now to partner with people from other professions. So having technology strong, tech-based people in your team and you being conceptually strong will really help organizations to increase their bottom line in such a way that ESG parameters are met, your environmental, social and governance parameters. And today what is happening is that we are getting lot of money, offshore funds coming into India, and they have this condition the pension funds of Canada, Australia entering India, they have this condition that the company should be ESG compliant. So we as your new age CAs, you can help organization to be ESG compliant. And one of the ways is to see that they take prudent decisions, and prudent decisions can only be taken if it is based on big data, and the big data analysis should be used in an ethical way. The source also should be ethical. The usage also should be ethical. I think I come to the last slide. And, thank you.
Thank you so much, ma'am, for that wonderful lecture of yours. Frankly speaking, it was like going through again, revisiting to the modules, cost accounting and financial accounting. But whenever it felt like, we have read something, but you made it more rich by sharing your experience, your practical, experiences, whatever you have gained throughout these years. Ma'am, it was actually so wonderful, whether it was going through that capital structure or capex or cash flows, or the way you discussed hubris syndrome, winner's curse, right? I must tell you that it was so amazing. Like when we see is when we study, we usually study at home, and we don't get such exposure at like the people at B school get. But the today's class, I must tell you, it was actually something that opened our minds to new spheres. So thank you so much for your lecture, ma'am. We have a number of questions here. So one of the questions is, can you please give us some tips or guidance for increasing working capital and keeping a business agile considering COVID-19 situation? So the question really, the person really wants to ask that keeping in mind the COVID-19 situation, how can we deal with the working capital problem?
Okay, so basically the problem today because of this pandemic situation, it's a vicious circle. Because you don't produce, you are not selling, and because you're not selling, you don't have the money to buy raw materials to produce. Have I understood the question right?
Yes, I think so, that
So,
the
so you
working
have
capital is stuck.
so you have to break the vicious circle. So you have to have money, you have to infuse funds to start your production, and you have to so that you sell and then you get the money to repay what you have taken on loan, the money. But the bigger issue is, will you be able to get loan because of your position today? And even if you can get loan, will you be able to repay it, or are you going deeper and deeper into the sinking pond? So at this point of time, I would suggest it's better to go in for partnerships. You
Right.
take a financial partner who has deep pockets and you have the technical know-how. So you don't take the risk and let the financial partner take the risk.
Okay, so that was the answer. So, ma'am, there's also one question that I have in mind, that, ma'am, what are the key points or key factors for startups when it comes to decision making? Nowadays we listen a lot about startups, even CAs and engineers and everybody is talking about startups. And when it comes to corporate decision making, at the very early stages, at the budding stages, some people look for angel investors, and some people try to, jot down their data or make some sense out of it. So what are the key points that we need to keep in mind so that we get good investment? Just like the Zomato IPO that we saw today, it hit the market and the capitalization was mind-boggling. So can you please help us with some of the points?
I'm glad you asked the question, because I'm a mentor to quite a few entrepreneurs, and it has just happened because some of my students, after a few years of job, have left the job and become entrepreneurs. One thing
Okay.
is that, like you see Sania Mirza, or you see the top Mary Com and all, remember that all don't reach the top. Means we have
Right.
not heard of people who have struggled and not reached the top. So out of maybe 10 entrepreneurs, just 2 or 3 manage to break even and become successful. So is it that the risk are you okay to take that risk? So that should be your level of passion, and that should be your level of mental attitude also, that okay, you have enjoyed the journey, but now you need to call it quits. So if your personality is such, I think only then you can go for a startup. And most of the startups who are successful, they have not depended so much on government funding. they call it bootstrapping. They first go in for their own funding and slowly bring in new funding from others. And you have, and again, it is big data analysis and SWOT analysis. Big data analysis will tell you what are the opportunities in the market, but SWOT analysis will tell you what your strengths are. Like I always feel that Malia was doing so well in the beer business. He messed up going to airlines because he saw an opportunity there, but he didn't have the strength. So you have to match your strengths with opportunities. So for a startup, the mistake that people do is they look at their opportunity, but they don't evaluate themselves. And knowing oneself is very, very difficult. We have this exercise in my college that very often, what you think you are, but you are not that person. You think you have certain traits, but you are not. You don't have those traits because we are influenced with what our parents thought of us, what our siblings thought of us. Like people have come to me and said that I always thought I enjoyed cricket, but now I realize I don't enjoy cricket. I enjoy tennis more. But why did you think that you enjoyed cricket? Because his parents would always tell him, "Isko bahut shauk hai cricket ka." So you sort of, you are conditioned by what your parents think of you or your siblings think of you. Later on, friends become very important. So you start behaving like in a herd mentality. Whatever your friends like, you start liking. And then later on in life, what your bosses thinks of you, what your peers think of you, in a startup, an entrepreneur should know what his or her strengths are. Only then it is possible. And let me tell you, a CA qualification opens many doors. It's a very strong qualification. And the rigors of the exam is such that you become very resilient and you become very hardworking. So you can do something, but that qualification should not stop you from doing something different. Right. You should not be chained by your qualification. It should be something which will help you to be successful in other things also, which you think you have the skill sets. So an entrepreneur needs this mindset, needs to know his or her strengths. So you cannot go in for a chemical business if you don't know anything about chemical just because there is a market for it. And of course, today you need to be very strong in data. You need to have a technical partner with you.
Right. Right. Ma'am, we have another question. If willing to start a career in data sciences, kindly suggest some programming skills and knowledge of tools that come handy for a chartered accountant.
So the easy way I would say is first try to see if you have an aptitude for it. There are very simple Coursera courses on data analytics. Do the course on that. Google about Microsoft tools. They are freely available. You can download it and see if you can apply them in your work. And unless they say you fall in the water, you don't learn to swim. Just doing the courses don't help. It has to be application based. So maybe you do some internship with Cognizant or Wipro or something for a month or so and also do the course and learn. And if you feel that you have an aptitude for it, then you can go deeper into it. But you can never be as good as an IITian. So leave that hard tech part to somebody else. But if you go in for say you outsource your investments to a portfolio manager, still you know the basics of the capital market, you know the fundamentals of the companies he's investing in. So similarly, even if you outsource it to a tech partner, you should know the fundamentals, you should know the basics on which the partner is relying and giving you the data, giving you the analysis of the data. So you know whether he or she is picking up the right data and the weights he's giving to the data is right, because you are conceptually stronger. So you know which data has to be filtered, which to be considered, which not to be considered. For that, definitely you need some background of machine learning, of AI, of blockchain, of Python and all. So you can do these Coursera courses, but maybe do the free courses so you don't need a certificate. So just do 1 or 2 courses, the sessions which give you an introduction to it. And then later on take up an internship or a project where you have to apply those skills.
Ma'am, just one last question we have from one of our participants. The participant is Vartika Podar, and she wants to ask what kind of roles are available in the industry for chartered accountants with data analytics skill.
I think the sky is the limit, because data analytics is required at every function, whether it is production, whether it is production department, whether it is finance department, whether it is marketing department, at every activity. So basically, you are there in an organization, say they say it is to improve the bottom line, to improve the branding, to improve the image, to see that the organization in the long run is sustainable, and the reputation of the organization is good, and it can stand the test of time. You don't want a fly-by-night organization which will go underwater because of some trauma like this pandemic thing. So you want to build a strong organization. So to build a strong organization, as I tell you, it is decisions. And the decisions you take today, the impact is felt much, much later. So the decision has to be right. And to take the right decision, you need to take it, we have seen, it should be based on data. It should be evidence-based decision, not by gut feeling, which was possible at once upon a time. But today, with the amount of competition and the margins being lower, you can't afford to take wrong decisions. So data analytics is required. Basically, in an organization, you have marketing, you have HR, you have finance, you have production. So for all four, you can choose whichever you feel you are comfortable with.
So sky is the limit is the answer for your question, Ms. Podar. And thank you, ma'am. Thank you for that wonderful deliberation. Now, I would like to invite CA Harsh Kumar Mittal, Vice Chairman, Faridabad branch of NARC of ICAI, to present a formal vote of thanks to ma'am. Sir, over to you.
Thank you, Saurabh ji. It's my privilege. You have given me another opportunity of thanks. First of all, I would like to thank today's speaker, Sangeeta Pandit ji, for taking such a wonderful and elaborate webinar on data analytics for corporate decision making. Ma'am, this was really a very informative and wonderful webinar, I would like to say. I would also like to thank all the participants who have joined us virtually. Also like to thank CA Charanjot Singh Nandaji, our Chairman, Committee on Management Accounting, for giving Faridabad branch as an opportunity to host this program jointly with his committee. And also like to thank CA Saurabh Arora, who has managed beautifully this webinar. Thank you. Thanks a lot. Saurabh, over to you.
Okay, thank you so much, sir. So, ladies and gentlemen, this was all about today's session, and with a hearty thanks to Sangeeta Pandit Madam and Vice Chairman Faridabad branch of NARC, Harsh Kumar Mittal, and in his absentia, Chairman Committee on Management Accounting, C.A. Charanjot Singh Nandaji. We would like to thank all of you for sparing your valuable time. So that is all, and we would like to take your leave. Okay, have a good day, have a great evening ahead. So bye for now. Thank you.
Thank you.
Thank you, Sangeeta Pandit Madam. Thank you, Saurabh ji. Thank you, Harsh ji.
Okay, okay. Please end the session.